2012's been one of our slower starts to the year. There's been 18 industrial investment transactions across Australia in 2012, and only 5 of those in New South Wales above $10 million. The largest industrial investment transaction in the country this year has been $75 million for Woolworths DC in Tasmania, of all places. And most of the activities in that $20 to $30 million range. We're seeing really low levels of supply and medium to high levels of buyer demand, both locally and really backing up what Nick Axe had said before that slide. The investment demand out of Singapore is really quite high in Australia for industrial product. If you look at Aviva, GIC, Mapletree, all have bought or want to buy. And over the last 3 years, industrial investments in Australia, GIC has really dominated that with the Salter acquisition and with the Australand development pipeline hookup. On yields, we're seeing prime A-grade industrial yields sitting around that 8 to 8.2%. That's on a 5 to 7 year lease. Anything that's less than that in terms of WALE is about 150 basis points higher than that, and we expect that to come into about 7.75 over the next 12 months. It's really going to depend on, as Rob said, some of the stock coming out of the super funds, and conversely those same groups wanting to buy as much as they can get.
Thanks, Joshua. Hear a bit about a move from south to west. Is that something we're observing, Jason?
Yeah, I think you hear a lot about people moving out of South Sydney. I just don't think that's necessarily the case. If you look at the tenancy profile in that market, you've got all of the major Australian industrial occupants having one or multiple holdings in that location, and that's just not going to change. Having said that, the occupiers or owners that don't necessarily have to be located in that precinct are being pushed further along the M5 down to the likes of Moorebank. And if you're a pre-lease inquiry, it's just driven by the land costs in that South Sydney market not making developments feasible. I guess the other thing is the occupancy costs. And if you look at the net rents, let's use the Central West as an example, you're only looking at a differential of the net face rent of $5. However, obviously occupancy costs include your outgoings, and in the south you're looking at 100% more on your outgoings costs than you are in those outer west areas.
Yeah, Jason, I might just jump in there as well. Look, I think that retail is probably impacting on South Sydney as well. 10 years ago we didn't actually have Alexandria Homemaker Centre, we didn't have Harvey Norman, we didn't have Domain in that area. So to service the actual eastern suburbs, this is really the only place they can go. Bunnings actually have a 20,000 square metre hardware under construction right now, and that's going to be the largest in the country. So I think it is actually impacting on your South Sydney market as well.
Thanks. Let's move to retail. Bricks and mortar. There's been a lot of talk about death of bricks and mortar retailing. Coming from banks, there was a lot of talk about branches, death of the branch in the late 90s as well. In fact, we saw branches fall from 7,500 to 5,000 over the decade of 2000, but we've seen a resurgence in the last decade. So business models have changed, and physical distribution networks haven't necessarily died out. What are we seeing in retail though, Alistair, around how they're responding to changing composition and channels of spend?
Sure. As we can see there, it's a pretty ugly slide. There's a lot of negative numbers, but what I will say is that retail will always continue to evolve. It's very easy to change a tenant over, to change tenancy mixes. I think there's also this furphy around online retailing. Realistically, online only represents about 5.5% of all retail sales in Australia to 2015. That's out to 2015. And you are seeing the likes of generic products like electrical and books that are failing, but they can be easily compared online. But what we're seeing in that space is an opportunity for people like Zara to enter in the market with the likes of the Borders store in Bondi Junction they've just taken over. They wouldn't have had that opportunity without that company failing. So it's a structural change that's probably occurring in the market. I also say that online retail grew to about 41% to May 2011. It's only grown by about 14% to May 2012. So it actually has slowed significantly. Only this week we've seen online retailers like Jenine actually pulling back their operations. So again, I probably highlight that it's a bit of a furphy. There's probably more issues, as we probably discussed, the deleveraging, households fixing their balance sheets. That's probably impacting retail. But as we say, we hopefully believe it's bottomed and on an upward trajectory.
And further to the furphy theme, potentially, has internet had an impact on industrial demand? Obviously, we're hearing that some of the growth in transport and storage is related to internet-based retailing.
Yeah, Steve, I guess we can only take a snapshot of what's occurred in 2012 to date. Of the major leasing transactions that have occurred across, in particular, Western Sydney, which is 5,000 square metres plus, online or e-tailers make up less than 8% of those commitments. Now, I guess for them in the medium term, it's trying to understand what footprint they require, and that's the challenge for their business as they continue to evolve. What that is leading to, though, is the e-tailers committing to either short-term tenancies or looking for 3PL providers to satisfy their needs.
Jace, if I can, where it's really affecting the warehousing component of the market is, as Jason just said, the freight and logistics groups are the groups that are seeing the growth out of it. We were recently talking with one of the major freight companies in Australia and trying to get to the bottom of their growth. And they were talking about static items. So an item like this glass, or they used barbecues as an example. Their clients are, with the value of the Australian dollar, buying 10 containers of product now as opposed to one. And that's all got to be stored somewhere.
Just turn back to retail for a moment from an investor perspective. So, Steve Lerche, what activity have we seen from investors in retail, and how are they responding to what looks like at least a headline level softer growth environment?
Despite the challenges in retail that Alistair's already alluded to, we are still seeing good, strong investor demand in prime retail assets. Retail has always been, sold to investors, and they are still one of the main investment avenues. What we are also seeing is the investments challenges, which are important distribution outlet for retail goods and also bulky goods. So despite all the challenges we're seeing, we really have investors scrutinising outgoings and the rents and rental increases, occupancy costs. So there are challenges, and investors are being cautious. Having said that, nationally, sales are actually up on 2011. $2.4 billion worth of retail investments were actually sold to June this year, compared to $1.5 billion last year. In New South Wales, the number of sales are actually down, but interesting, there have been 13 retail investments that have happened to June this year. Majority of those have been single tenanted assets or smaller neighbourhood centres under the $16 million mark. And the retail, the two retail outstanding transactions have been firstly, Home Hub, which is at Castle Hill. LaSalle bought that for $180 million at 9%, and that's one of the riskier sort of asset classes at the moment in bulky goods. The only other asset that's over that $16 million mark is Totally Home at Bella Vista, which was bought by the New South Wales government